All right, I'll go ahead and kick us off. Thank you guys for coming to our now fourth FFI Live, which is crazy to think that it's almost been a full calendar year that we've done this. These have continued to grow, and me and Daniel have been very excited to see the trajectory of this and the continued interest in this as well. For those of you I don't know, my name is Haley Rowland. I am the Director of Marketing and Communications at FGM. I have the pleasure of co-hosting this webinar with my awesome colleague and research director, Daniel Doderer. So without further ado, we'll go ahead and get started. But before then, this call is being recorded and we will have it up on our YouTube channel later today, and you guys will get a follow-up email from me with that link. But if you have any colleagues or any friends in the financial or steel community that you want to forward this along to, feel free once I send out the link. But Daniel, take it away.
Thank you, Haley. And as you mentioned, thank you everyone for joining us. It's been good to see that some people have been with us since the beginning. We also definitely want to say thank you to the people who are joining us for the first time here. As we've said before, the feedback here is really helpful and really important to us. We're excited to be sharing some of the insights that we have. The goal is to just increase curiosity within the industry, to maybe start thinking about things in a slightly different way, and to really add context into the bigger picture of what's going on in the industrial side. So without any further ado, we'll go ahead and just jump in from here. The theme for today's call, the most important one, the thing that I hope runs through, is the idea of short-term pain versus long-term gain. It would obviously be fairly disingenuous to say that what's been going on in the industrial side of the economy and in the steel industry over the last 6 months has really been very rosy. We've seen a melt in prices. We've seen disappointments on the demand side, and there's maybe some typical summer seasonality of concern about the future. And while it's all justified, I think that if you dig into the details, if you dig into the data, and you think about the long term, there's a lot to be encouraged about. So we'll more specifically go into supply side dynamics. Imports have been kind of the name of the game for the second quarter. We'll take a look at that, and we'll start kind of talking about maybe what that's going to look like going forward. Domestic production, which has also stayed, maybe surprisingly elevated. We'll go into maybe some reasoning behind that, and then we'll go through kind of the normal construction manufacturing demand. We've also included a slide on auto demand for this round, so we'll touch on that as well. Taking a step back from steel specifically, and just looking at the U.S. economy, at FGM we really like to keep ourselves on our toes. So we decided to announce a webcast on the same day when GDP was going to be announced. Obviously high risk, but in this case, pretty good reward as well. For anyone who hasn't seen, GDP was incredibly encouraging. It was a very strong print. If you look at some of the underlying fundamentals, maybe there's some nits to pick, but by and large, 2.8% of growth from quarter over quarter is very encouraging. Even more encouraging than that is the fact that it is based primarily off of consumption. So it's showing that the consumer remains strong. If you look at a lot of the details on the consumer side, you can see very clearly that a lot of the wealth that had been generated from the pandemic in the early stages continues to drive activity forward. Another really interesting and encouraging signal for the second quarter growth was not only investment but also building inventories. We'll obviously talk about building inventories on the steel side specifically, but that was another driver of positive growth. The only real drag was net exports. We continue to bring in more than we sent out. Somewhat unsurprisingly given the nature of the U.S. economy. But when we think about the other kind of big picture risk to the economy right now, being inflation, an increase in net exports isn't necessarily the worst thing either. So moving right on to that. The chart that we're looking at here, if you've been on the webinars before, then you've seen this one before. For those who haven't, our little spaghetti bowl here is made up of CPI in the blue. We have the core CPI, which strips out food and energy as the solid line. The top line CPI number is dotted. It's going to be similar for PCE, which is the solid white line. So the top line number is dotted. The core, which is kind of the measure of underlying price pressure, is the solid line. We've even bolded it and highlighted even further because that is the most important. It's the one that the Fed looks at. It's the figure that the Fed is trying to get down to 2%. That is the target for the Fed to bring inflation down to what's estimated as a reasonable level for economic activity and for just churn going forward. We've also included the PPI, which is Producer Price Index. The core figure here is the orange one. It's important to keep that in mind. The surge in PPI, was a clear indication of goods prices increasing. So you do need to contextualize that and kind of keep that front of mind while you're thinking about inflation. What you can see most clearly is that PPI is kind of the softest among all of them. It remains just above the target. So after the description, taking a step back, in the April webcast, when we talked about inflation, we were starting to see some signs. There's my mouse. Some potential signs of, resurgence potentially. Just additional stickiness is maybe a better description of that. And the risk of resurgence was kind of coming down the road. Since then, we've really seen that come back into a disinflationary trend. We're seeing the big picture drivers from 2023 continue to play out. Some of the temporary risks which brought us to the place where we were when the Fed started hiking have fully moved into the rearview mirror. There are risks in the future. We're not out of the woods yet. There's a lot of reason to believe that this last leg might take the longest, and that there still is a prolonged period of time with restrictive rates before we get to 2%. But we're in a very encouraging trajectory. So taking a step back from maybe some of the bigger picture macro drivers, we'll look more into steel. So I mentioned the supply side for anyone who's in the industry. One of the big talking points was the surge in imports. What we're looking at here on the chart, the white line is sheet arrivals by month, and then we've included also our internal forecast model for import arrivals. That's the yellow dotted line. We like to think that, or we have found that what's more important than actual arrivals is the expectation of arrivals, and even more so how actual arrivals come in versus the expectation. So what you can see here is that the expectation from the forecast model was for a surge in the first and second quarter of the year. When you look at actual arrivals, that's exactly what happened. Part of the reason why we didn't necessarily get to the peak the model had suggested largely was due to supply chain issues. We look at the model going forward. We think the expectation of moving back towards or back just below the long-term average for arrivals is exactly how it's going to play out. We don't anticipate any additional upticks after July. Really, when you think about July, the big driver of the slight uptick was just the fact that carry trades in March were more viable. So moving on to the larger component of supply, that's obviously going to be domestic production. We have the chart here going back to the beginning of 21, just to add some additional context. What's really notable is the fact that there's been some volatility, but that we've been in a pretty tight range essentially since the second quarter of 23. So that's a prolonged period to be kind of in this tight range. What's maybe curious or a question that one might have when observing kind of what's happened with pricing over the last 6 months is why is production as high as it is? When you take a step back, and that's obviously what we're trying to do here, we do see that domestic mills are still making a lot of money at current levels, at prior levels especially, even where it currently stands today. Mills are still making money, and there's certainly an incentive for them to continue producing to keep leads shorter and to disincentivize imports going forward. We'll move into now a bigger picture supply. We've included another component in the data that we're looking at here when we're thinking about supply. So we looked at imports. We also looked at domestic production. The white line here is our kind of internal supply model. We've included inventories here. That's kind of the big kind of missing piece to the things that we had talked about before. But let's take a step back before we talk about right now and kind of think about how we got here and think about what's been going on with prices over the last couple of years. In 2022, we were coming off of an incredibly high year of very strong output, very strong demand in 21, and even though prices were coming in, demand remained very high. Supply, all things considered, was fairly elevated at that point in time. So by and large, even though there was a gap in the model, that was largely offsetting. Demand above supply was offsetting and leading to volatility. What's interesting in 2023, when we look at kind of the middle section of the graph here, we see demand softer, we see supply softer as well. What's notable about that year is that we actually did see essentially two rallies over that time period, two significant rallies over that time period. Obviously, the first started at the end of 22. The second came in towards the end of or the middle end of 23. But when supply and demand were that close and restrained, that's when we saw a lot of volatility, and we saw a lot of upward price pressure, pockets of demand kind of coming in when supply was a little bit more restrained. But now we turn to this year, and we turn to the last 6 months, and we can clearly see that the downward pressure, the melt in prices, is entirely driven by a surplus, just too much material and not enough demand. Taking a step back from demand, it's also important to have the correct categorization of demand. Demand essentially is unchanged. A slight uptick in the beginning of the year. It's come down a little bit since then in this model, but essentially unchanged since 2023. So that's about a year and a half of demand that is not cratering, that continues to show green shoots, but is not really seeing upward momentum. And that's essentially the way that when we hear other people talking about it, they categorize it in a similar way. You can look at certain reasons for these headwinds. We'll dig into them in more idiosyncratic ways when we talk about the specific demand components. So without further ado, this was mentioned as a new slide. So the auto sector is one that we've more vaguely talked about on these webinars. We did want to include this slide because it's pretty illustrative of kind of what's going on here. When you look at the underlying demand for cars, the figure or the relationship that we tend to lean on is going to be unemployment, and low unemployment as a real encouraging surge for auto demand. And if you think about where unemployment is, even though we've seen a bit of an uptick from here, it's in an incredibly strong, incredibly tight historic position. At 4.1% was the last reading. Again, there was a time not too long ago when people thought that essentially the capacity of the U.S. economy was 4.3% for unemployment. That obviously was disproven from 2018 essentially to very recently, but 4.1% unemployment while cooling is a very tight labor market. So the question is, with such a tight labor market, why have we not seen a real encouraging signal from auto demand? And you can kind of look at the last couple of years and you can think about the fact that the chip shortage was uniquely impacting the auto industry negatively. And then by the time that was more or less resolved, affordability became the primary concern. So what we're looking at here is auto inventories in the blue line, and then we also have auto production in the white line. And it's quite notable when you look at what's been happening since the beginning of 2022, which we have kind of the low highlighted here. This was when the Federal Reserve began hiking interest rates. So even before the Fed started hiking rates, for Fed funds, mortgages, and also other forms of borrowing had already been on the rise there. And what we can clearly see is that affordability is the primary concern. On the bottom of the slide here, we reference the University of Michigan Consumer Sentiment Survey. One of the specific questions that they've been asking since 2014 is essentially, is now a good time to buy a car? And we're seeing that consumers are saying that it certainly is not. It's improving, but since 2014, we're at very low, very restrained levels. So affordability being a primary concern, it's notable to see that production essentially over this time period should be, in our view, is categorized as flat for a prolonged period, while inventories are increasing. So it just is an affordability concern. Is kind of primarily the way that we categorize it. Once we get down the road for more for more interest rate cuts, and affordability is less of a problem. We do have a lot of optimism on auto going forward. Another potential hindrance is maybe the mismatch of items that are being produced versus what's being demanded. Obviously, there's been a lot of talk of EVs and EVs sitting on lots. That definitely could be contributing to the surge as well. But moving on from auto to the construction, this is another chart that we've looked at before. The way that we kind of categorize construction right now is certainly mixed. So when you look at the residential side, there's a lot to be encouraged about. There's an incredible amount of pent-up demand for residential construction. We mentioned in the auto sector that affordability is a concern. Affordability is also a concern for housing, but there certainly is an incredible amount of demand for housing. So we anticipate continued stability, continued growth on the residential side. But one of the strongest statistical relationships that you can see on the industrial side of the economy is the lag in non-residential compared to residential spending. So if you look at the trend for residential, you see that following interest rate hikes, residential really slowed down. What we're seeing now is that about a year and a half to 2 years later, which is the historical relationship, the historical lag, now non-residential is kind of being impacted in the same way that we saw residential impacted. You can see that more broadly if you look at the ABI index, has been certainly discouraging, and you can also see that in the Dodge construction data as well. So our broad outlook, more or less, for non-residential is that it is going to be a little bit softer for the next couple of months, for the next couple of quarters specifically. But there's also good reason to believe, just given the way that financing has worked more broadly, that the drawdown won't be as rapid as it was for residential. But on the other hand, it is also likely that it could last a little bit longer than it did for residential. Now, offsetting some of that is what we see here in the yellow line. This is the public sector construction spending. You see a very clear surge, obviously going back to the beginning of 2022. We anticipate that, given especially all of the legislation that's gone forward, that public spending should soften the blow, a big portion of the blow that we anticipate on the non-residential side. We're very encouraged by by the opportunities there. And thinking about non-residential, it's important to also recognize that there are certainly some strong pockets that should kind of level off some of that downside move. Moving on to manufacturing, this is really the bread and butter of where we see steel pricing. So we mentioned a 1.5 to 2 year lag in non-residential spending. When you think about construction spending, it's fairly well planned out. So there's typically very little impact on steel pricing from the construction side, but where prices are driven comes from kind of the marginal ton, and the marginal ton typically in the U.S. economy comes from the manufacturing sector. So the chart that we're looking at here is the ISM manufacturing PMI in white, and then you also have the S&P Global U.S. manufacturing PMI in blue. The red line is the expansion contraction line. What we can clearly see over the same time period that we've generally been talking about was that we had incredibly strong demand in 2021, kind of record expansion in the way that it was measured for both PMIs, and then a bit of a slowdown, or a clear slowdown through 22, and then some contraction in 2023. What we've seen here going forward, largely it did seem like, if you look in the data, there was a clear expectation of an increase in demand from interest rate cuts. And the fact of the matter, we've mentioned it in calls prior, is that those cuts did not materialize. So with that kind of context in mind, and maybe some additional information that I'll be teasing for the next slide, there is good reason to believe that there's potentially an artificial restraint in the manufacturing sector. You can see clearly that there were green shoots and some signals of optimism, as we started moving towards expansionary territory. And then for much of this year, we were kind of getting a mixed view from the difference between S&P Global and the ISM manufacturing, both being slightly in contraction or slightly in expansion territory. The data from yesterday showed that the S&P Global did dip slightly. 49.5 is very, very slight contraction. That's essentially at a neutral board. So the overall view, or the overall feeling from the executive side who are responding to these surveys is, by and large, that we're mixed. That it's not great, it's not terrible. We're just kind of muddling along for the last 6 months. I think this chart is going to be the most notable. And when we think about short-term pain, when we think about long-term gain, and we think about everything that's been happening essentially from the pandemic to today, we think about all of the investment, all of the reshoring, everything that was happening all the way back from 232 and a lot of the trade policies that have been transpiring. This chart very clearly shows the long-term potential for the U.S. industrial complex, but also for steel consumption going forward. So I'll go ahead and describe what we're looking at here instead of just kind of vaguely talking about a few white lines. So our solid white line here is industrial production. So it's output that the Fed is measuring. And it's more or less been normalized so that you can compare times historically. The red line shows the all-time high, which was recognized in September of 2018 at 104.1 is the figure. The dotted line, which is even potentially more notable for the future, is capacity utilization. So with the recent readings of industrial production, we see that we are now producing just shy of an all-time high. And I think if you would look back at the manufacturing PMIs and you kind of hear from the executives how they see the business, how they where their general outlook is, I don't think that anyone would characterize this as good as the end of as 2018 times. But the fact of the matter is that output is incredibly high. And when you think about capacity utilization specifically, what we're seeing here And the decrease in capacity utilization, essentially since 2022, is clear investment in the United States manufacturing and industrial sectors. So when we see that, we're at a just shy of an all-time high for output, and we're fairly restrained. We're at a low level, obviously ex-COVID, and ex the shocks that impacted, a normal business cycle, kind of low on the industrial capacity side. Um, there's really a lot to be encouraged about demand going forward. So, I would love to from here take any questions. Would really love to be able to dig into anything a little bit more deeply if there's any more curiosity. But I'll go ahead and leave the presentation with that. On top of that, look at that honk. Let's. I want to encourage everyone to sign up for our upcoming FFI. It's going to be the full year. At that point, October 17th, at 1 p.m., same time, same place. You can go ahead and sign up on the QR code right there. So without further ado, Haley, do you have any questions?
Yes, I have one that just came in. The question is, what do you think is the impact of Nucor's CSP?
Yeah, that's for those of you who don't know, I can't imagine that anyone on the call would not know the Nucor CSP. So that's the price that comes out 10 a.m. Eastern. It's Nucor's spot price for hot rolled coil. Thinking about that price, obviously, it's important to recognize that we've only seen it in a down market up to this point. And we've only really seen it with pretty significant downside surprises. I would venture to guess that even though it's maybe held prices a little bit elevated, I think that there probably is some regret, likely with Nucor releasing that. I think that I think that they're being somewhat forced to manage expectations, and if the market thinks that it should be here and it's not there, then you see some pretty significant reactions, and it's kind of just put a cap on potential rebounds that could have potentially transpired.
All right, we got another one. It says interest rate cuts now or down the road.
Yeah, so I think that what's currently being priced in, I just checked this morning. Obviously, there was surprisingly very little reaction to an incredibly strong GDP print. But currently, what's being priced in the market is a cut in September, November, December, and then additional steady cuts from there. I think if you look at the dot plots most recently, the Fed's currently pricing in 2 additional rate cuts. I think September is the right time for a cut. I think if you look at the context of GDP and you look at the context of where the overall economy is growing, continuing to grow, while you also have receding inflation, it's time to it's more or less time to not risk it. Like, you did your job. It's coming in. Inflation is coming in. The economy is remaining strong. Soft landing is a scenario that I don't think a lot of people anticipated, really, when we started hiking it at such a rapid pace. But it's where we are, and now it's kind of managing what the next part of the cycle is going to be. So September, I think is the right time to cut. It's kind of what the data suggests as well, and it is also kind of what the Fed is hinting at too. More than likely, my internal view, and this is just opinion, probably a 25 25 cut every other meeting is kind of a likely outcome. Being able to manage the rate lower so that they can eventually keep it higher, because they definitely do want to keep it higher. And in the case of a recession down the road, the ability to cut and to stimulate growth is something that they didn't have more recently. And I think that's something that the Federal Reserve does need going forward.
Okay, we have 2 more questions, 3 more questions. So I guess we'll answer all of them, but for those of you who need to hop off, feel free to hop off again. I'll send the link later. Referring back to the last slide, does this represent significant upside potential for manufacturing production that simply has not been tapped into yet? And then the follow-up to that is, what will it take for this increased capacity to be utilized?
Yeah, I think that's a great way to categorize it. That's exactly what it is. We've mentioned a few times in our FFI reports. We've also mentioned in some of our daily research that manufacturing as a portion of construction spending has seen some incredible growth. So that's essentially a very clear signal of investment in manufacturing. That's how we're now seeing it in the data. So the manufacturing investment, the ability to produce more, has been a part of the investment. It's now being realized in lower capacity utilization levels. So going forward, I think the second part of the question was, what's it going to take for that utilization to increase? I think there are some real big picture questions that are happening right now. There's two kind of overhangs in the market right now, and there's a decent amount of uncertainty because of it. The first being obviously the presidential election. It's I'm not sure if there are any questions about that, but just to briefly kind of talk about the outlook there. Between Trump and Biden, it was fairly clear that both were very protectionist, and that even though there was differences in policy, that the industrial side of the economy, the steel side of the economy, was very clearly in a bipartisan way going to be protected. It's early to say on what Kamala's policies are going to be, and obviously she needs to officially get the nomination. But I think that at this point, now that we've seen many years of industrial policy from the federal government that's been supportive, I think that there's no reason to believe that that's not going to continue in the future. Likely something that's standing in the way right now is simply just the uncertainty of what that policy is going to look like, what the framework is going to look like going forward. So I think once the election is resolved, I think that business is going to continue to produce. There's just maybe a pause on waiting for what that framework is going to look like, and that's more or less how I see that playing out on the presidential side. Looking to another restraint, another reason why utilization is at a softer position. I think that there's the potential for an artificial holdback on with elevated rates. So as soon as we start seeing interest rate cuts, as soon as we see that the Fed is moving into a cutting regime, by all means, I think that some of that artificial restraint is going to be removed, and we'll see higher levels of utilization and higher levels of output as well.
All right. Yes, there was a question about the election, so you already answered that one. The next one is, can we anticipate an increase in construction and manufacturing spending with rate cuts despite the lag in non-residential construction?
Yeah, we kind of touched on that in the last question as well, and I think we definitely can. I think that what you had seen going into 2023 was just hockey stick kind of growth, just this incredible amount of investment, and then that was kind of the initial wave, right? Is everyone very excited about? Oh, there's a ton of spending in manufacturing, and then you saw it level off, for the rest of 23. But then following there, we've kind of seen that start to increase again here, and our belief is definitely that should continue. Now, manufacturing is a small part of overall non-residential spending, but we are encouraged about that, and we do think that there's a lot of opportunity for that going forward.
Awesome. And this is a similar question, but we have two more, this one and then another one. But do you think corporate interest rates will lag behind to the Fed cutting rates and possibly keep a damper on manufacturing domestically for a few years?
I kind of actually anticipate the opposite. I think once the first cut is out of the way, once the election is over, I think the election probably has potentially more of an impact, given the fact that Trump's policy is likely going to be very different than the Democratic policy. So once there's some more clarity there, I think we'll see movement on the corporate rate side. But as soon as the Fed is beginning the cutting cycle, other rates tend to lead it. We saw on the mortgage side specifically that about 6 months before the first hike is when mortgages started to rise. I believe there were more than 140 basis points above where they had been 6 months before the first hike. So we should anticipate that once there's a clear signal of the trend that we're headed towards, markets are going to react faster than the Fed.
All right, and last question. With competition for prime scrap expected to rise with the new steel capacity coming online, is scrap going to be more volatile in 2025?
I that's a good question. I think the plain, straightforward answer, without getting into any of the technicalities or graphs, is that it certainly should be. There's restricted supply is definitely going to lead to higher volatility. And I think that's definitely going to be the case going forward, and elevated and more volatile.
Awesome. All right, I think that covered all the questions. If you have any more questions, please feel free to email myself. It's on the Zoom invite, and then I can pass them along to Daniel. We can make sure we get those answered. But other than that, thank you guys again so much for attending today, and then we hope to see you again in October.
Thanks, everybody.